Welcome back to Talk Tickers. If you're listening, you are looking for the signal in the noise. We're the show that strips down earnings calls to the raw data and the tradable signals.
We don't care about the fluff, just the numbers that move the needle.
And today, we had a classic market divergence on our hands, a real head-scratcher. We are breaking down H&R Block, ticker symbol HRB.
It's a fascinating setup. And, frankly, one of the more interesting prints we've seen this cycle. We're looking at their fiscal 2026 second quarter results.
Okay, so let's set the stage. Q2 for H&R Block. This is basically their off-season, right?
Exactly. It covers August, September, October. This is historically the quiet before the tax season storm.
Right. It's usually a ghost town for tax prep. I mean, nobody's waking up in September excited to file a 1040.
Not unless they're in trouble, no. So usually there's not much to see here. It's a maintenance quarter. But this time, the market reaction tells a very, very different story.
And that's the hook. This is the textbook definition of a beat and drop. And I mean a violent drop. On paper, they beat the top line. They beat the bottom line.
And yet
the market absolutely hammered the stock. It shed over 7% to close at $34.56.
And that drop happened on heavy volume. We're talking 5.28 million shares. That's roughly 3 times their normal average.
So that's not retail panic. When you see volume like that on a beat, it means institutions are selling into the news.
They are. So the mission for this deep dive is clear. We need to unpack why a double beat resulted in such a sell-off. Is the market spotting a structural flaw, or is this, a massive overreaction?
Let's start with the headline numbers then, because if you just glance at a terminal, you'd think this was a great quarter. What did the financials actually look like?
Well, they were surprisingly strong for an off-season quarter.
Yeah.
Revenue came in at $198.9 million.
Whoa, hang on. That's up 11.1% year over year.
It is.
11% growth for a legacy brick and mortar company in their slowest quarter. That sounds incredibly bullish.
It was a huge beat against consensus, which was sitting around $187 million. The growth came from a couple of places. First, higher assisted tax prep volume, so late filers. But the more important metric was the higher NAC.
NAC, right, net average charge.
Yep, it's the average price they charge a customer. When NAC goes up, it means they have pricing power, they're charging more, and people are paying it.
Okay, so they have volume growth and pricing power. That's usually the holy grail. What about the bottom line? I assume a loss, given the time of year.
Oh yeah, a loss is fully expected. You have to remember, H&R Block has this massive fixed cost base rent corporate staff that they pay all year round.
They're just keeping the lights on, waiting for April.
Exactly. But looking at the adjusted EPS, it came in at a loss of $1.84.
And what was the street expecting? Context is everything here.
The consensus was bracing for a loss of $1.96. So they beat the bottom line estimate by 12 cents. They lost significantly less money than everyone thought they would.
Okay, so let me recap the good column. Revenue beat, earnings beat, pricing power is up, volume is up. Play devil's advocate for me. Why on earth did the stock tank 7%?
Okay, this is where we have to look past the headlines and into the guts of the report. The devil is in the details, specifically in the OPEX and EBITDA lines.
EBITDA, the proxy for cash flow from operations.
Correct. And the EBITDA loss actually widened slightly. It went to $266 million compared to $261 last year. The market basically ignored the revenue beat and just zoomed in on the fact that cash burn is increasing.
They saw smoke in the kitchen.
They did. And when you look at operating expenses, or OPEX, it hit $497.7 million. That's up 5.4%.
5% doesn't sound like a catastrophe, but in a low-margin business like this, that matters. What's driving that cost up?
It's a mix. But there are 2 main drivers that spooked investors. First, higher field wages. They're paying their tax pros more. Unavoidable.
Sure.
But the second driver was the sticky point on the call. Specific consulting costs related to a strategic sourcing initiative.
Strategic sourcing.
Right.
That sounds like classic corporate bingo. It's almost a red flag for me whenever I hear consulting fees on an earnings call.
Usually raises an eyebrow. The CFO, Tiffany Mason, she was very much on the defense about this. She claimed these costs will drive sustainable savings for reinvestment later.
Right, jam tomorrow. But the market is seeing the cash leave the building now.
Precisely. Investors are skeptical. They're seeing the burn before any of the savings. And with the stock already down 30% in the last quarter, the market is not in the mood to give them the benefit of the doubt.
And there's another layer here, isn't there? If you're paying consultants to fix your costs and your costs go up, you can see why traders hit the sell button.
It screens execution risk. And that brings us to the strategic pivot. Because despite the costs, management sounded incredibly confident. They have a new CEO, Curtis Campbell, and he's pushing this narrative. Expert-led, tech-enabled.
Which sounds great on a slide, but what does it actually mean? Are they just slapping an AI sticker on the same old software?
For once, I think there's some actual substance here. It is heavily reliant on AI, yes, but they have a specific use case that's genuinely interesting. It's called Second Look.
Second Look. I feel like I've seen that commercial for 10 years. Bring us your old returns, we'll find you money.
You have. But it was always a manual, niche thing. It relied on a human tax pro sifting through a stack of paper. It was time-consuming, inconsistent.
And
Now, they're scaling it with AI. A new client walks in, the tech ingests their last 3 years of returns, even if they were done on TurboTax, and it automatically scans them for missed refunds. Instantly.
So they're weaponizing AI to find free money for customers. That is actually a brilliant client acquisition tool.
It is. Think about the psychology. If they find you $1,000 you missed 2 years ago, you're probably a customer for life.
That makes sense. It turns a commodity service into a potential treasure hunt.
Exactly. And they also rolled out AI Tax Assist for their own pros, trying to reduce the grunt work.
Which brings us to the macro picture. You can have all the AI in the world, but you need people to actually need tax help. And management kept bringing up one specific thing, the one big, beautiful bill.
It's a strange name for a law, isn't it? But they cited it repeatedly. And it has introduced drastic tax law changes that kick in for this filing season.
Break that down for me. What actually changed?
A lot. The standard deduction is up $750. But more importantly, there are really complex changes to how tips are handled, overtime pay deductions, new senior deductions.
So complexity, chaos.
Massive complexity. And complexity is H&R Block's best friend. Their entire thesis for this year relies on it. They believe this confusion will drive people away from DIY software and toward assisted human help.
Ah, I see. They're betting people will be too scared of making a mistake on these new deductions to do it themselves on an app.
That's the bet. They're aiming to capture clients who are terrified of leaving money on the table. And management assumes the whole industry is flat about 1% growth. So this isn't a growing pie. It's a knife fight for market share.
And they're betting the house that assisted takes share from DIY this year.
Specifically, they're projecting a 20 basis point shift from DIY to assisted, which doesn't sound like a lot.
But in an industry this big, 20 basis points is huge money.
It is. And if that shift fails to materialize, the whole thesis breaks.
So what about guidance? Despite the OpEx scare and the consulting fees, did they change their outlook for the year?
No. And that's the confident or maybe stubborn part. They reaffirmed the full year 2026 outlook. Revenue between $3.875 and $3.895 billion. Adjusted EPS between $4.85 and $5.
That feels aggressive. If they're down on EBITDA now, reaffirming guidance means they have to perform even better in Q3 and Q4 to make up for it.
That's it, exactly. It implies a massive weight on the upcoming season. They have to execute flawlessly. There's zero room for error.
Okay, so talk to me about capital allocation. Are they putting their money where their mouth is, buying back stock?
Aggressively. They returned about $508 million to shareholders in the first half. And there's still about $700 million left on the authorization.
That's a lot of dry powder for buybacks. That should put a floor into the stock, theoretically.
Theoretically, yes.
Right.
It shows management thinks the stock is undervalued.
All right, so let's summarize the bear case before we move on. Why did the stock drop 7%?
It's the trust factor. The stock was already down 30%. Investors are spooked by the widening loss. They hear consulting costs for future savings, and they just translate that to runaway spending.
And they dismiss the beat as just off-season noise.
Exactly. The market is saying, we don't care about Q2. We care that your costs are up 5% and you're banking everything on a perfect tax season.
And what about their small business platform, Wave?
That was a bright spot, actually.
Right.
Wave continued double-digit growth, strong performance in their pro-tier subscription. So they are diversifying, but it's still too small to really move the needle for the whole company.
Okay, so catalysts to watch in the next few weeks. The season is kicking off right now.
Early season data is what you watch, but the real metric is refund size.
Why does refund size matter so much?
Because of the new bill. Early indicators suggest refunds might be larger this year. And there's a strong correlation. If refunds are bigger, people are happier. And if people are happier, pricing power goes up and volume usually follows.
That makes perfect sense. If I'm getting a fat check from the government, I care a lot less about paying H&R Block an extra $20.
Exactly. If we start seeing headlines about record tax refunds, that is a flashing green light for HRB.
Right, we've looked at the numbers, the strategy, the risks. Now let's move to the segment everyone waits for.
The disclaimer first.
Always. This is not financial advice segment. We are not financial advisors. We're just two voices breaking down data. Do your own diligence. Don't trade based on what we say.
Okay, now that we are legally clear, let's talk about the trade.
What's the pitch? You have a name for this one?
I'm calling it the complexity straddle, or maybe more accurately, the 1040 panic long.
The 1040 panic long. I love it. Walk me through the setup.
The one big beautiful bill has introduced chaos, tips, overtime, new deductions. It's a mess. The average taxpayer just cannot handle this.
Okay, I follow you.
Right now, the market is pricing HRB like a melting ice cube. They think the assisted model is dead. The stock is down 30%. Sentiment is in the gutter.
So where's the edge?
The edge is incompetence. We are betting on the incompetence, or really the anxiety, of the average filer. We're betting that DIY software churns users hard this year. Imagine you're a waiter. You log into TurboTax, and it's asking you 20 complex questions about tip allocation under the new bill.
You freeze. You get worried you're going to trigger an audit.
You panic. You realize you might be messing this up, or worse, missing out on that bigger refund. So you close the app, you get in your car, and you drive to the strip mall.
A panic migration to the pros.
Exactly. A migration to brick and mortar in March.
Right.
We're betting on fear driving foot traffic.
So what's the trade structure?
You go long HRB, specifically targeting April expiry calls. You're buying the dip created by this Q2 cost scare while everyone else is puking the stock.
Catching the falling knife.
With a Kevlar glove.
Yeah.
And here's the outrageous upside twist. If that AI-enabled second look actually works, if it finds free money for customers automatically, HRB stops being a boring tax filer and starts being a refund bounty hunter.
A refund bounty hunter. That is a powerful narrative shift.
Think about the word of mouth. Hey, I went to Block, they found me $1,200 from 3 years ago. If that narrative takes hold in Q3, the stock gap fills this recent 7% drop and runs to the top of the range. We're talking $37 plus.
So you're looking for the beat and raise narrative to emerge in Q3 based on volume the market thinks isn't coming.
Precisely. And remember, the short float is over 9%. That's a lot of fuel. If the volume data leaks early and it's good, those shorts have to cover. You could get a squeeze.
And the hedge. What if we're wrong?
Well, that's the risk we talked about. If the savings from the consultants don't show up and the DIY software is good enough, then you're just holding a bag of expensive retail leases in a dying industry.
And the stock continues its slide.
Correct. But the risk reward down here at $34 is compelling. It's a classic contrarian bet on human behavior over technological efficiency.
So to recap, H&R Block delivered a beat and reaffirmed quarter that the market absolutely hated. They're spending money and they're betting the farm on tax code complexity.
And the disconnect between management's optimism on complexity and the market's fear of OPEX, that's where the opportunity lies.
It's a fascinating setup. Does that 7% drop look like a discount or a warning sign to you? That's the question you have to answer.
The data is there. The choice is yours.
Thanks for listening to this deep dive on Talk Tickers. We'll catch you on the next print. Talk Tickers out.